All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another recycled business cycle narrative that you can comfortably ignore while you scroll. This is about a specific liquidity mechanism that is draining cash from the real economy right now in real time. And it is killing small businesses at a pace we have not seen since the darkest days of the 2008 financial crisis. Between January and December 2025, over 52,000 small businesses filed for bankruptcy in the United States. That is a 34% increase from the previous year. But here is what the mainstream business media, CNBC, Bloomberg, the Wall Street Journal, is not telling you. They will tell you it's about inflation. They will tell you it's about labor costs. They will tell you it's about changing consumer preferences. They are wrong. This is not about poor management. This is not about failing to pivot. This is about a structural liquidity drain that has severed the connection between small businesses and the credit system they depend on to survive. Regional banks, the institutions that provide nearly 80% of all small business loans in this country, are pulling back. They are tightening lending standards at the fastest rate in decades. They are calling in credit lines. They are refusing to renew operational loans, and they are doing it because their own balance sheets are under extreme stress from commercial real estate losses and a deposit flight that has not stopped since the Silicon Valley Bank collapse in March 2023. We are witnessing a slow-motion credit seizure in the small business sector, and what makes this crisis different and frankly more dangerous from 2008 is that it is happening without the screaming headlines. It is happening without the government bailouts. It is happening without any significant policy response from the Federal Reserve or the Treasury. The system has made a calculated decision. It is letting small businesses die to preserve the capital ratios of the banking system. If you own a business, if you employ people, or if you have capital sitting in regional banks, you need to understand exactly what is happening. You need to understand why waiting and seeing is no longer a neutral position. It is a losing position. In the next 25 minutes, I am going to walk you through the mechanics of this liquidity drain step by step. I am going to show you the historical parallels from 1930 and 1989 that prove this pattern is not new. And most importantly, I'm going to give you the 3 asymmetric plays that allow you to not just protect your capital, but position yourself to acquire distressed assets at generational valuations. By the end of this video, you will have a strategic framework that most small business owners will not see until they are sitting in a bankruptcy attorney's office filing Chapter 11. So stay locked in, because this is the kind of information that separates those who survive systemic stress from those who get wiped out by it. The liquidity mismatch, why profitable businesses die. Before we dive into the current crisis, you need to understand the foundational framework that governs how liquidity flows or stops flowing through the economy. Most people, even experienced entrepreneurs, think about business failure in terms of profitability. They think if you have a good product, if you have customers, and if you are making a profit on your P&L statement, you are safe. But that is a fundamental misunderstanding of how businesses actually die. Businesses do not die from a lack of profitability. They die from a lack of liquidity. You can be profitable on paper, you can have net income, and still go bankrupt next week if you cannot access cash to meet payroll, pay suppliers, or service debt. This is called the PAPWL liquidity mismatch problem. And it is the silent killer of small businesses in every credit contraction in history. Here is how it works mechanically. A small business operates on thin margins and uneven cash flow. Revenue comes in on net 30 or net 60 terms from customers. That means you do the work today, but you don't get paid for 2 months. However, your expenses, payroll, rent, supplier invoices, utility bills, are due immediately. To bridge that gap between cash out and cash in, businesses rely on credit. They use a business line of credit from a regional bank, a corporate credit card, or invoice factoring. That credit is the oxygen that keeps the business alive during the gap. It is the working capital that smooths out the volatility. Now, imagine what happens when banks tighten credit, when they reduce that credit line from $100,000 to $50,000, when they increase the interest rate from 6% to 12%, or when they simply send a letter saying, we are not renewing your facility next month. That oxygen gets cut off. The business can still be generating revenue. It can still have a full order book. But without access to liquidity to bridge the gap, it cannot operate. It cannot buy inventory to fulfill the orders. It cannot pay the workers to make the product. It defaults on obligations. It lays off workers. And ultimately, it files for bankruptcy. Not because the business model failed, but because the banking mechanism failed. This is exactly what is happening right now across the United States. and the scale of it is being deliberately obscured by the way the data is reported. The core thesis of this video is simple but critical. We are in the middle of a regional banking crisis that never resolved. It simply moved off the front page. The regional banking trap, the source of the drain. The stress that killed Silicon Valley Bank, Signature Bank, and First Republic in 2023 did not disappear. It metastasized. It moved into the balance sheets of hundreds of smaller regional and community banks, and those banks are now quietly deleveraging by cutting off small business credit. This liquidity drain is creating a two-tier economy. 1. Tier 1. Large corporations, S&P 500 companies, with access to capital markets. They can issue bonds. They have investment-grade credit ratings. They can borrow at reasonable rates because they don't depend on bank loans. 2. Tier 2. Small and medium-sized businesses, Main Street. They depend almost entirely on regional bank loans. They are being systematically starved of capital. The result is a wave of bankruptcies that is accelerating, not slowing. If you understand this dynamic, you can see the asymmetric opportunity. Distressed business assets are coming to market. Commercial real estate is trading at massive discounts, and there is a booming demand for hard money lending to creditworthy borrowers who have been abandoned by traditional banks. But you have to move now because once this becomes obvious to the general public, the window closes. Historical parallels, 1930 and 1989. Now, let's turn to history because the pattern we are seeing today is not unique. It has happened twice in the last century with devastating consequences for those who did not recognize the warning signs. Parallel 1. The banking panic of 1930-1933, the Great Depression. Most people remember the stock market crash of 1929, but that was not the event that destroyed the American middle class. The real devastation came in the 3 years after, the crash when the banking system collapsed. Between 1930 and 1933, over 9,000 banks failed in the United States. These were not investment banks on Wall Street. These were community banks, savings and loans, and regional institutions that served farmers and small merchants. When those banks failed, they took the liquidity of Main Street with them. But here's the critical detail that gets lost in the history books. Those bank failures followed a specific sequence. 1. Banks that had loaned heavily into real estate and agriculture saw those loans go bad as asset prices fell. 2. As loan losses mounted, banks cut off new lending and called in existing loans to preserve capital. 3. Businesses that depended on those credit lines could not operate, so they defaulted, which created more loan losses for the banks. 4. Depositors, seeing the stress, began withdrawing their money, which drained liquidity and forced banks to sell assets at fire sale prices. 5. The entire system seized. Credit disappeared. Businesses failed by the thousands. The investors and business owners who survived this period were the ones who moved their deposits out of stressed banks early. They stopped relying on bank credit, and they positioned themselves to buy distressed assets, farmland, machinery, buildings, at pennies on the dollar when the cycle bottomed. Parallel 2, the savings and loan crisis, 1989-1992. This one is less famous but even more relevant to today. In the 1980s, savings and loan (S&L) institutions were the primary lenders to small businesses and commercial real estate developers. They loaned aggressively during the boom. But when the economy slowed and real estate values fell, those loans went toxic. By 1989, hundreds of S&Ls were insolvent. The government created the Resolution Trust Corporation, RTC, to liquidate them. Over the next 3 years, 747 institutions collapsed. During that period, small businesses that depended on S&L credit lines were cut off overnight. The RTC didn't make new loans, they liquidated assets. The result was a massive wave of small business bankruptcies that peaked in 1991 and 1992. The investors who made generational wealth were the ones who bought distressed real estate from the RTC at 30 to 50 cents on the dollar. They understood the liquidation cycle. The lesson from history is clear. Liquidity drains create asymmetric opportunities, but you have to have capital, you have to have patience, and you have to move before the distress becomes consensus. The current mechanism. Why banks are pulling back. Now, let's bring this into the present. Why are banks tightening credit now in 2026? Why didn't this happen sooner? The stress started in March 2023 with SVB. SVB held a large portfolio of long-duration treasury bonds and mortgage-backed securities bought when interest rates were near zero. When the Fed raised rates, the value of those bonds collapsed. SVB wasn't insolvent because of bad loans. They were insolvent because of interest rate risk. When depositors realized the bank's assets were worth less than its liabilities, they ran. $42 billion left in a single day. Here is what the Federal Reserve and the FDIC did not tell you. SVB was not unique. Hundreds of regional banks are holding the exact same underwater bond portfolios. According to FDIC data, U.S. banks are sitting on over 500 billion in unrealized losses on securities. These are hidden losses. They don't show up on the income statement unless the bank sells the bonds. But if depositors start withdrawing funds, the bank has to sell the bonds. And the moment they do, the losses become real, capital's wiped out, and the bank fails. Regional banks know this. They are terrified of it. So their response has been to aggressively conserve capital. How do you conserve capital? You stop lending. You stop making risky loans. And in the eyes of a bank regulator, a small business loan is the riskiest asset class there is. So banks are reducing credit lines. They are tightening underwriting standards. The National Federation of Independent Business, NFIB data shows that the percentage of small business owners reporting credit is harder to get has risen from 6% in 2022 to over 32% in late 2025. That is a massive contraction. At the same time, interest rates on these loans have jumped from 4.5% to over 9%. So credit is scarcer and twice as expensive. For a business with 10% margins, that math doesn't work. It is the difference between profit and insolvency. The cascade effect from credit cut to bankruptcy. This tightening happens quietly. It happens one loan officer at a time. A business owner calls their banker to renew their line of credit, and they hear, "Sorry, we can't do it this year," or "We need you to pay down the balance in 30 days. This triggers a cascade effect. 1. Cost cutting. The business lays off workers to preserve cash. 2. Payment delays. The business stretches payments to suppliers. Net 60 becomes net 90. 3. Inventory reduction. The business buys less from wholesalers. 4. Contraction. The entire supply chain slows down. Eventually, the business runs out of runway. It defaults, it files for bankruptcy. The data proves this is accelerating. 2024, 39,000 business bankruptcies. 2025, 52,183 business bankruptcies. 2026, YTD. On pace for over 60,000. We are approaching 2008 levels of failure, which peaked at 64,000 without a stock market crash or a visible recession. It is a silent depression for the small business sector. Asymmetric play number 1. Distressed business acquisition. Understanding the problem is useless unless you can profit from it. Here is the first asymmetric play: distressed business acquisition. When a small business fails due to liquidity, its assets don't vanish. The equipment, the customer lists, the brand, the skilled workforce, they are all still there. In a bankruptcy or a distressed sale, these assets are sold for pennies on the dollar. The key is to identify businesses that failed because of liquidity, not because of viability. Scenario A: a restaurant with bad food and no customers. This is a bad business. Do not buy it. Scenario B: a construction company with $5 million in signed contracts but no cash to buy materials because their credit line was cut. This is a good business with a bad balance sheet. Buy this. If you have capital, you can acquire these assets at 20 to 40 cents on the dollar. You recapitalize the business, restructure the debt, and stabilize operations. You are buying cash flow for 1x or 2x EBITDA, earnings before interest, taxes, depreciation, and amortization, when it should trade for 5x. The return on investment here can be 300% to 500% over a 3 to 5 year hold period. A symmetric play. Number 2, hard money lending. The second play is hard money lending, private credit. There are thousands of profitable, credit-worthy businesses that simply cannot get a bank loan right now. They are desperate for capital and willing to pay premium rates. This is where private investors step in. You become the bank. You lend money at 12% to 15% interest. You secure the loan with hard assets, real estate, equipment, inventory. You lend at a low loan-to-value LTV ratio, say 50% or 60%. If the borrower pays, you make a double-digit yield in a flat market. If the borrower defaults, you foreclose on the assets and acquire them at a steep discount because your LTV was low. This is a defensive, high-yield strategy. You are filling the void left by the regional banks. A symmetric play number 3, physical gold and silver. The third play is be the Physical precious metals. As a liquidity hedge, this might seem unrelated, but it is directly tied to the banking stress. Small business owners who are losing trust in banks are moving capital out of the system. They are liquidating assets and buying gold and silver because these are assets with no counterparty risk. Drought. When credit markets seize, gold becomes the ultimate form of liquid private wealth. Central banks bought over 1,000 tons of gold in 2025. They know what is coming. Smart investors should allocate 10 to 20% of their liquid capital to physical metals, not ETFs, stored outside the banking system. It is your insurance policy against a systemic lockup. The action checklist. Here is what you need to do right now. 1. Stress test your credit. If you own a business, call your banker today. Don't assume your line of credit is safe. Ask hard questions. If you sense weakness, start raising alternative capital immediately. 2. Build your deal pipeline. If you are an investor, connect with bankruptcy attorneys and business brokers. Tell them you are a cash buyer for distressed assets. Get on their call lists. 3. Audit your banking exposure. Check your bank's balance sheet. If they have high exposure to commercial real estate or unrealized bond losses, move your deposits. Diversify. Do not keep more than the FDIC limit, $250K, in any single regional bank. 4. Get physical. Buy gold and silver. Secure your own liquidity. 5. Stay informed. Watch the data. Ignore the headlines. Follow the loan officer surveys and bankruptcy filings. Conclusion. The liquidity drain is real, it is accelerating, and it is reshaping the American economy right now. The question I want you to answer in the comments is this. If you are a business owner, have you felt the tightening? Have you seen the terms change? If you are an investor, are you buying distressed assets yet, or are you waiting for the bottom? Let me know. If this video gave you value, smash the subscribe button. We are tracking this crisis in real time, and my next video will break down exactly which industries are failing fastest. Share this with someone who needs to hear it. The exits are closing. Don't be the last one trying to get out. I'll see you in the next one.